A strong demand for gold and silver was sparked by the banking crisis of 2023. Now, depending on who you talk to, some people believe this is a one-off event, while others believe it is the beginning of a sustained bull market for precious metals. Now, we all have an opinion about the sector, no matter what direction we take. The beginning of a bull market or bear market has always been triggered by a catalyst. As an example, let's look at Lehman Brothers. A well-known investment bank, Lehman Brothers filed for bankruptcy in September of 2008, which triggered the subprime mortgage crisis and led to the collapse of the economy and stock market. Something eventually was going to cause the bubble to burst, with a bubble in the stock market and a structurally weak economy. In spite of the banking crisis driving strong demand and higher prices in the precious metals market, it is only the tip of the iceberg and is not the only driver for continued strength. There are many reasons why we expect gold and silver to perform well in the foreseeable future, but for the purposes of this video, we'll primarily focus on monetary policy, interest rates, debt, and inflation. Although you may be familiar with some of these factors, we hope that you will be able to share some thoughts and insights that may shed some additional light on the current situation. Federal Reserve Monetary Policy. Founded in 1913, the Federal Reserve controls the monetary policy of the United States. How does monetary policy work? A monetary policy is a fancy way of describing how much money is in circulation. When the Federal Reserve wants to stimulate the economy due to slow growth, which typically occurs during a recession, they will print money to help stimulate lending activity. Instead of printing more physically, these days they just add digits to their balance sheet electronically. As a result, government bonds are bought, resulting in lower interest rates. Recently, they have expanded their purchases beyond government bonds to include mortgage-backed securities and corporate bonds. As historically been the case, that cheap money or artificially manipulated interest rates have blustered the demand for lending and credit, which results in more business activity such as new business startups, business expansions, and a strong housing market. In contrast, when inflation is running hot, historically the Fed has had a 2% inflation target. They withdraw liquidity. Bonds are sold into the bond market to accomplish this. Having more bonds on the market tends to raise interest rates and making financing less attractive for entrepreneurs, businesses, and home buyers. The Federal Reserve has been pushing a tight monetary policy at this time of this video. Through the sales of bonds and the increase in the federal funds rates, they have been reducing their balance sheet. How does the federal funds rate work? It's the overnight rate at which banks lend each other money to meet liquidity needs. Indirectly, the federal fund rates affects the price of mortgages, credit cards, auto loans, and commercial loans, just to name a few. Additionally, it incentivizes banks to park excess reserves at the Fed at a significant interest rate. Currently, the Fed pays around 5% to banks on excess reserves deposited with it. To mitigate the risk, banks can choose not to lend and receive a risk-free guarantee rate of approximately 5% if they are concerned about repayment ability. With recent increases in mortgage rates, we're starting to see weakness in the commercial and residential housing sectors. The estimated monthly payment for a $500,000 home purchased with a 30-year mortgage at 3% a year ago was around $2,000 a month. At the current rate of 7%, your monthly payment would be over $3,000, which is simply unaffordable for most middle-class Americans. How monetary policy affects gold and silver prices. As we've discussed, higher interest rates affect lending and real estate, but what about gold and silver prices? Historically, tighter monetary policies have resulted in lower and gold silver prices as higher interest rates tend to strengthen the dollar. Since there's less liquidity floating around, this makes sense. Moreover, higher interest rates encourage people to save, especially if the return is inflation adjusted. Loose monetary policy, on the other hand, means that more money has been created without corresponding increases in goods and services. Now, we're all experiencing price inflation at the grocery store, at the gas pump, as more money chases a fixed number of goods and services. Since more dollars are created out of thin air, this expands the monetary base and weakens the dollar. In environments where the dollar is weakening or inflation is high, gold and silver tend to perform well. Now, gold and silver prices should have fallen over the past year, given that the Federal Reserve raised interest rates from 0% in March 2022 to 5 to 5.25% at present, and official inflation has dropped from 9.1% in June 2022 to roughly 5% at the time of this video. Despite a brief dip into the 1600s in September and October, gold finished the year in positive territory and has been on a tear ever since. It is important that all of us keep in mind that monetary policy, in a way, is kind of like a double-edged sword. The Fed's continued increase in interest rates and withdrawal of liquidity from the system will contribute to an economic slowdown. In addition to an increase in corporate bankruptcy filings, we are already seeing weakness in the commercial and residential sectors. During the first quarter of 2023, 70 major companies filed for bankruptcy, which is comparable to the number of businesses closures during the Great Recession of 2008 and 2009. Consumption is clearly tightening in this country. In addition, we are starting to see an increase in unemployment benefits filings and a weakening job market. The headline jobs reports only scratches the surface of what's really going on. Government and service sector jobs account for the majority of the new jobs being created. The majority of those jobs in the service sector are typically low-paying and part-time, and government jobs have no real economic benefit. A slowing economy will certainly affect the service sector first, since fewer people will have discretionary income to spend on activities such as travel, hotels, movies, restaurants, and exact. Debt, deficits, and debt serving costs. Our discussion so far has focused on the monetary side, but we haven't discussed the physical side, which is a ticking time bomb. How do we define fiscal policy? This is the government's ability to properly budget. Basically, they spend less than they receive in tax revenue. We've been running deficits of over $1 trillion per year since 2020, and are projected to do so for the foreseeable future as well. Over and above what they collect in taxes, the federal government spends more than $1 trillion per year. It is approximately 20% more than their annual revenue. As a result of fiscal irresponsibility, our national debt has risen to nearly $32 trillion, with a GDP of roughly $25 trillion in 2022. Our debt to GDP ratio will be around 120%, which is a banana republic territory. The GDP is the market value of all goods and services produced during a year, or in other words, the country's output. Globally, there aren't too many countries that can spend more than they produce. Now, due to low interest rates, we have been able to service our debt as a nation. The national debt interest payments in 2022 were $475 billion, which is the seventh largest government expenditure behind Social Security, Medicare, Medicaid, and defense. And we had an average debt servicing interest rate of approximately 1.5% when we ended 2022 with a national debt of $31.4 trillion because of low interest rates. We have been able to spend well beyond our means. If the federal government continues to run $1 trillion deficits and foreign central banks continue to liquidate their U.S. Treasury holdings, there will be a limited number of buyers for our government debt. A lack of buyers will result in higher interest rates, which makes sense, since investors are taking on more risk if they purchase government bonds from a highly indebted country. With higher interest rates, the government will have a hard time servicing its debt, leaving the Federal Reserve to pick up the slack. By purchasing government bonds to prevent interest rates from getting out of control, the Federal Reserve can pivot, which means that they shift from a tight monetary policy to a loose monetary policy, thereby weakening the dollar and possibly causing price inflation and monetary inflation. And if they so do pivot, I believe that we can expect double-digit inflation in the years to come if they do this before they are able to control inflation. Financial experts are predicting perhaps stagflation, which is the worst of both worlds. The term stagflation refers to a state of high inflation, high unemployment, and little or to no growth. Let's discuss the future direction of gold and silver. Over the long term, we can expect gold and silver prices to increase. There will be times when investors take profits off the table, of course, causing prices to, consolidate. But the long-term trajectory is positive. Despite expectations to the contrary, gold and silver prices have been performing well. With the Federal Reserve shifting policies, we can expect gold and silver prices to reach new highs in perhaps the not too distant future. Other potential catalysts for gold and silver's prices have not been discussed, including the formation of the commodity-backed BRICS currencies, rumors of a gold-backed Chinese yuan, legislation by Congress to adopt a gold-backed currency, and legislation in Texas to create a gold-backed digital currency, just to name a few. As a result, countries in the East have added to their gold holdings in recent years, with Russia, Turkey, China, and India being the largest buyers of gold. Additionally, these are all countries rumored to adopt a BRICS currencies, which is likely to be backed by commodities or even, like precious metals, perhaps gold. We have covered a lot in this video, so why don't we do a quick recap. Now, the Federal Reserve is pursuing a tight monetary policy, which historically has adversely affected gold and silver prices. Even a far from ideal environment for precious metals continue to perform well. There are many potential black swans that can cause prices to rise even more, including a banking crisis. The Federal Reserve is stuck between a rock and a hard place. By raising interest rates, withdrawing liquidity from the system, debt servicing costs will rise above acceptable levels. Additionally, it will cause an already fragile economy to plunge into a severe recession, perhaps even a depression. A loose monetary policy may lead to inflation rates escalating out of control, making it nearly impossible to control. Furthermore, it will cause foreign countries to speed up their de-dollarization process and continue to weaken the dollar. In addition to the Federal Reserve, the federal government is also responsible for the problem. We wouldn't need the Federal Reserve to intervene in the economy as they have in recent years if they were physically responsible and operated within a balanced budget or even a surplus. Debt servicing will soon become the largest line item on the U.S. government's budget if we keep going at this pace. Although none of the above policies are ultimately good for America, they are beneficial for precious metals such as gold and silver. In the event that the U.S., which has substantial gold reserves, or the BRICS nations adopt a gold-backed currency, prices will skyrocket. Stackers of gold and silver may finally have their day in the sun. Gold prices may not reach six figures, but they will significantly rise from their current levels.